Thanks for tuning in to the NWR Virtual Investor Conference, May 2020. We have Perennial Value Management up next. Perennial is a boutique active Australian fund manager with about $5 billion of funds under management. Perennial is focused on delivering excellence in funds management through equity ownership, and they also provide actively managed exposure to a portfolio of Australian smaller company shares, employing a value-style investment process. Sam Berridge joins us today. He joined Perennial Value Management in April 2012 from the Royal Bank of Scotland in Sydney, where he held the role of Metals and Mining Analyst. During that time, he won Starmine's 2011 Top Australian Metals and Mining Analyst Award. Sam commenced his career in the mining industry, gaining open pit mining and exploration experience across key commodities, including gold, nickel, iron, and uranium. Over to you, Sam.
Thanks very much, Laura. Look, I've sat through enough of these presentations to know that a good presentation is a fast presentation. So we'll rip into this and see if we can leave plenty of time for Q&A at the end. So starting at the very high level, commodities as a sector, I think it's worth pointing out, has been absolutely disgraceful over the last 10 years. This chart you can see in the top right there is the Bloomberg Commodity Index versus the S&P 500, and thanks to the oil rolling over in the last month, it is at 50-year lows versus the S&P. So it is an unloved sector, but just the degree and the historical context of this is important. 50-year chart above, but just in the last sort of 5 years or so, you can see it's really ticked down just in the last month. What this means is asset allocation has moved away from the space, and with that, investment expertise has moved away from the space as well. Now that leads to a more inefficient market. When you've got less people looking at the space, you can have larger examples of shares being mispriced, and that makes it easier to outperform. And we've put our money where our mouth is in that regard. We've started a global resources fund that began trading on the 1st of April. And we're happy to say that in our first month, we reported 21% net of all fees, which I was very happy with that result, not least of all because a decent wedge of our cash is invested in that fund. So stepping down a little bit, just looking at the broader market, because regardless of what's going on in the commodities space, it is subject to the ebbs and flows of the wider share market. I think it's worth pointing out, just in these very sharp moves we've had in March and then into April, in green here, we've got the earnings per share of the S&P 500. I mean, it's been in sharp decline for the last month or so, and I don't think we're at a bottom there yet, and I'll discuss that in further. But with this sharp tick up in the actual S&P 500, what that has meant is that the price to earnings ratio, which we've got here in yellow, is sort of trading back in line with where we were, in sort of December, January, when the world was a much rosier place. So, there's a lot of risk, I think, out there that the market is discounting at the moment. And so my point is that this rally that we've seen in April and carrying on into May is built on pretty shaky ground. But just to have dig a little bit deeper into that, let's have a look at some of the sort of macroeconomic and business indicators in the US. So we've got a number of indicators here. Number of businesses open. This is small business in the US. I mean, this is a pretty disastrous chart. 50% of them is closed, along with hours worked. Freight looks horrible as well, ticking down. And, not interesting chart here with US car sales, just comparing, the recent sell down due to COVID versus the financial crisis. This has been a very sharp pullback, and it is going to create a bit of damage throughout the economy, which is going to take a little while to recover. Now, how will that recovery look? Well, obviously, this was all caused by the COVID virus. In the center here, we've got the number of daily US infections. These little dips we've got here in the middle, they're Mondays. So, it's not pullbacks in infections. It's just the way that they're being recorded and reported. So, the curve is not really rolling over. It's just going sideways. And you can see why that's happening in this chart down, or these series of charts down below. is that the number of infections are improving in the coastal states, but it's just moving inland. So, and you can see, all these charts in the middle here are still looking pretty ordinary. And at the same time, you're seeing the US, US population getting pretty annoyed and jacked off with these lockdown restrictions. This photo in the top right here was taken at Huntington Beach in California last weekend. This is a protest about the lockdowns, and regardless of your politics, I think it's beyond debate that when you have these sorts of gatherings going on, it's not good for the number of infections. Chances are they're going to increase. So if we sort of wind all this back to what the earnings outlook in the US and what the price to earnings ratio are, I think people or commodity investors just need to be a little bit mindful that this rally does appear to be on shaky ground, and there might be another opportunity to enter some of these prices. Enter some of these stocks at better levels over the next month or so. But it's not all doom and gloom. I mean, the one bright light is China, quite often where the commodity debate starts and finishes. And as you can see with these charts here, coal consumption at their power plants is sort of there or thereabouts, being flat year on year. Steel inventories are being dragged down, in line with seasonal levels. You've had a decent tick up in new car sales as people have opted to try and buy a car for their commute, as opposed to catch public transport, which they're a little bit wary of at the moment. But as you could understand, but I suppose my point here is, whilst China is recovering and it is a cause for optimism in commodity markets, China needs to offset the weakness in the rest of the world for these commodity prices to rally. And whilst China is definitely recovering, I don't see a recovery to the extent rest of world weakness can be offset. So I think that's the key point I wanted to make on this slide and the ones previous. Looking forward though, the level of demand out of China is going to be impacted by the amount of stimulus that their government undertakes. Later this month, there's a National People's Congress meeting, which it is possible that stimulus could be dialed up and commodity demand along with it. But just at the moment, this chart on the right here just shows sort of M2 money supply, which is a proxy for sort of financial stimulus, is at a pretty modest level compared to previous campaigns the Chinese government has undertaken. So, and whilst the rest of the world, as you can see this chart in the bottom left here, has undertaken much greater quantums of financial stimulus to date, it's not particularly commodity intensive. I mean, you can see that with what's going on in Australia. The government's spending a huge amount of money, but it's not going on infrastructure. It's going on food and rent and wages and things like that. So, for the time being, that real strong sort of commodity demand impulse has yet to be fired. Now, that may change, but for the time being, I still think that, the supply-demand balances, acknowledging that there have been some supply curtailments in the mining industry due to COVID, but on balance, I think things are still trending into surplus. And if that's the sort of the outlook at the moment, and then you can sort of compare that to where prices are today and versus the cost curves, there are some producers that are cash negative at current rates, but compared to where we got to into the GFC, I mean, these prices are still pretty good in the scheme of things. And these, I think I did these, so I put together these charts last week. So copper's moved up a little bit here, and so is nickel. On a risk reward basis, with this sort of macroeconomic backdrop that we've got at the moment, this risk reward doesn't look so great. But one area where it does look a lot better, and that's oil. So oil cost curve on the bottom left here, WTI is at around $24, $25 today. So, that's sitting right down the bottom of the cost curve. So pretty much everyone here is losing money. The focus, more recently has been on North American shale. I mean, there's a big range, but, you need sort of $50 plus to sustain production or justify new well developments in US shale. And that's miles away from where we are at the moment. And unlike mining, for the oil producers, if you just leave them be, fields will naturally decline. You have to take an active decision to go and invest more capex to sustain field life, whereas mines will keep on operating at their run rate unless you stop them. So with capex being cut back, circa 30 to 40% across the industry, these natural field declines will start to kick in. On top of which, you've seen some of the large international oil companies announce production cutbacks of circa 12 to 15% in the last couple of weeks. So relative to where the oil price is, I think the risk reward looks a little bit more compelling. This chart on the right here is of note. Come from Princeton Energy Advisors. They're trying to forecast here when or if we hit tank tops in the US. If we do that, then oil will probably spike down again. But as we saw sort of earlier in April, even when the price spikes down, the broader market knows that the oil price cannot stay at zero. It has to bounce. And so the equity or share prices through that period were quite resilient. So I think if we can get through May without hitting tank tops in the US, that's probably going to be the bottom for the oil price. From moving from a market where no one's making any money to a market where everybody's making quite a bit of money, is gold. We'll move on to gold. So I think as a lot of people are already aware, gold is probably most closely correlated to US real rates, and we've got a chart in the top right that highlights this. Just this little spike in real rates in April. What that was caused by is not so much a lift in US government yields. It was driven by a drop in inflation expectations, and that's because the oil price plummeted. So that's why that's popped. But there's other structural tailwinds, I think, for gold. So the gold price has largely looked through that. As oil price ticks up and as hopefully the rubber starts to hit the road as far as some of these stimulus initiatives are concerned and economies do open up, inflation expectations are going to start to increase again. To get the real yield, you deduct that inflation off the nominal yield, and that's how you end up with a negative number. And so I suspect you'll see this US 10-year real yield starting to head in a negative direction once again, which is prima facie bullish for the gold price. Some other tailwinds you've got. A chart down in the bottom left is the gold price versus the US Fed balance sheet. The correlation here is a little bit rough, but more broadly, when you've got the Fed basically buying debt off the US government, otherwise known as quantitative easing, that is positive for the gold price. And just earlier this week, we had an announcement from the US Treasury in which they confirmed or clarified that rather than having a forecast surplus for the June quarter of $56 billion, they're going to require to borrow $3 trillion. That will then later up that the next day to $4 trillion to fund the US government through the June quarter. So, assuming the Fed buys most of that, you're going to see this white line here continue to increase, and the gold price probably along with it. So there's sort of more short-term drivers of the gold price. Longer term, and I think probably one of the more bullish charts on gold, even though it's you have to sort of step away from the market a little bit to appreciate the ramifications, is this chart in the middle. So this is a survey. It was done last year on whether or not US voters consider the budget deficit to be a problem. And you can see, from sort of 2014 onwards, people are becoming less and less concerned about the amount of debt in the US. And you can sort of see that in public policy. Like the Republicans and Trump has been stacking on debt like there's no tomorrow. The Democrats are not interested in reducing the deficit either. There's no political incentive to go and tell the voters that, oh, hang on, we've got to tighten our belts and get the budget back into order. And if you then compare that to the this chart on the right, and this was all done before the COVID virus broke out, but this projection of US debt, which has been like this for a long way, has gotten materially worse over the last few months, and that means that for the US government to finance the debt that it's in, they're going to have to keep interest rates low. But then to get a real rate, you deduct inflation expectations off that. Real rates are going to stay negative for a very long time, and that's a structural tailwind for the gold price, which I don't know how this sort of situation resolves itself, but in which case it's a tailwind for the golds, and with that in mind, we'll move on to the equities themselves. So how I've approached pardon me, how I approach gold equity investing is firstly just looking at the producers here to begin with, and some of the near-term producers as well, with Capricorn and Ora Banda included on the list. I've ranked these stocks by EV to EBITDA. I mean, FY20 is pretty much done, so we'll look at it. We'll look at FY21. EV EBITDA, so EV over EBITDA is not my favorite metric, but it is one for which consensus is readily available, and that's what we're looking at here. If you sort of you run your eye down the numbers here, you can see there's a sort of a distinct group or break between the earnings multiple that this group of 6 companies are being awarded for their earnings compared to sort of the next group of 6 behind them. And you normally the earnings multiple reflects the risk or the quality of those earnings, whereas I think in this instance you can start to say, well, let's dig into that a little bit. Companies like Silver Lake, Gold Road. I mean, Gold Road's only a single asset company, a bit of risk there. I mean, Silver Lake has got two producing assets, but I think mine life is a bit of a question mark there, particularly compared to a company like St Barbara, which has got a very long mine life at Gwalia still, and a decent runway over at their Canada operations. So I think whilst you have a rising tide in terms of the gold price will lift all boats, if you want to outperform within the space, what I look for is not just growing earnings, but also looking for catalysts to re-rate the multiple that those earnings are attributed. And with that in mind, I think Ramelius is looking interesting. You see today they've got to 90% of spectrum, so they will absorb that Vivian deposit into their guidance over the next month or so. There's a very high grade deposit, which means that once that's factored in, it's going to drop their group all-in sustaining costs, as well as increasing group production as well. So you've got a situation here where gold production is going to be increasing, costs are going to be falling. You've got a number of new shares on issue there, so there's always the possibility of a re-rating from the Ban X of the world and the passive gold funds, which was a big tailwind behind Silver Lake. That one's near and dear to my heart. I mean, we were Dore's largest shareholder when they merged with Silver Lake. You put those two companies together, you ended up with a more liquid company, increasing gold production. They got picked up by the passive ETFs, and that drove the share price from 90 cents on to $1.30, and it's gone onwards and upwards from that point. Just lastly on this slide, and before I hand it over to questions, it's probably just a word worth touching on the developers. In recent history, we've had some pretty average outcomes for investors from new companies going into production. Gascoigne and Dacian spring to mind, but I think that means that there is an opportunity for investors to have a look at some of these newer would-be producers or near-term producers coming through, because I think the quality of assets and management teams there is probably a bit above what we had with Gascoigne and Dacian up until their MD has been replaced recently. So of the developers, I think Bellevue is worth a good look. A very high grade asset. I think there's maybe a bit of skepticism around whether or not that grade or that deposit will hold up under closer space drilling, but we're going to get an answer on that in the very near term. So I think Steve's actually up after me, so you can pepper him with questions on that one. And but my take on it is that it looks like that that grade is going to hold up, which means the economic hurdle for that deposit has been crossed well and truly, and we'd be looking, they'll be looking at going into development in the reasonably near term. So I'll leave it there for the time being. I'm told that there's a few questions available, so with that in mind, Laura, I think I'll open it back up to questions.
Thank you so much, Sam, for that comprehensive overview, including the macro component of it. We've had a question come through from Peter, just as you had that chart up on the last slide. He wants to know how you absorb the risk of jurisdictions like Africa into your preferred order for your gold stocks in particular.
Well, it's a good question. I mean, it's a subjective measure. So generally speaking, we don't invest a lot in Africa for that reason. I mean, you can see West African resources. You can see there is looking extraordinarily cheap and probably too cheap for what they've achieved. It was an excellent commissioning that they had, but to circle back to your question, yeah, it's a subjective measure. By and large, we stick to investing in first world countries. I mean, you don't want to wake up one day and find out that a coup's gone on or something like that. It doesn't help you sleep well at night.
Really not.
Yeah, that's it.
And Sam, you're clearly an active value investor, and the debate between passive and active fund management has been going on for more than a decade now. Someone wants to know, as an active value investor in the resources space, how closely do you monitor ETF activity on companies, on the companies that you invested in?
Yeah, we keep a reasonably close eye on it. I mean, I think a year or so ago, it was pretty easy or easier to front run or predict which companies were going to go into and out of the ETFs and get ahead of that. I mean, back in the day, I think Regis Resources, when they were having problems at Garden Well, you had a big tranche of Vanex selling down at $1, which we were happy recipients of, and we sold it back to them up closer to $2. But in this day and age, I think they've become a little bit better at hiding their hand. So we're mindful of it. But in terms of performance, down in the sort of small cap and mid cap space, it's a lot easier to outperform the ETFs than it is in the large cap space, and that's because in small and even into micro caps, the market's more inefficient. So you can do the research, you can foresee where the market's going before it gets there and invest accordingly. So it's certainly not in terms of competing on performance, it's certainly not as big of an issue in resources and small caps as it is in the sort of ASX top 20.
Thanks, Sam. And you spoke about event catalysts, or catalysts in general, of being pretty high importance to you for re-rating equities. You do look for that. How do you look at special situation plays as well as M&A plays? There may be more M&A activity in the near future. We've observed from some of the research reports coming out, given the difference in multiples between large players versus mid and small players in the space, particularly in the gold space.
I think you sort of always need a plan B. Like you can look at a company and think, well, this is ripe for a takeover, but you need a fallback position. So if we can invest in a company and think, oh well, I mean, this is an obvious takeover target, but if that takeover doesn't happen, then there's catalyst X, Y, and Z for the re-rating of that company to take place. That's the way we frame it. But and to your point, I mean, I think the market is ripe for gold M&A. I think this point I sort of make on the slide about M&A, MPVs being irrelevant outside of M&A. I mean, that does make it easier for the larger miners to purchase an asset at MPV or even slightly below MPV, but once they bring it into their own portfolio, those assets are being valued at sort of 1.5 to 2 times MPV. So, it is a sort of a good market or a positive market for M&A. That said, though, it's not, there's no guarantees that, that you're going to have success. And I think the acquisition that St Barbara made recently is a case in point. I mean, in my opinion, I think they clearly overpaid. The market seemed to agree, and they punished them for it. So, you still see some instances of cash being torn up, but by and large, as long as boards are disciplined, I think investors will reward them for M&A in this gold market.
Thank you, Sam, for your time. We are out of time right now. We have got more questions to ask you, but we'll be passing them on to Sam in due course. Thanks for joining us today.
No worries, Laura. Pleasure. Thanks very much.
And thanks everyone on the call. Next up, we have Bellevue Gold. Stay tuned. They'll be up in about 4 minutes' time.